Be starting shortly, so maybe something like a couple of minutes, letting people still join. It says people are still joining in, but I believe we can give it a start. With all the concern all over, financial press today was replete with stories of what have been the concerns on the circular. Share prices of several NBFCs took a hit. With all of this, I would still wish you all a good afternoon. The background to this circular was building up over the last few weeks, ever since the data about increasing growth of consumer credit was being flashed. The Reserve Bank of India had probably some meeting with senior bankers as well, and the bankers assured that everything is okay, don't worry, we are using our controls, we are making sure that the risk is taken care of, etc., etc. All those assurances were not obviously enough to assuage the fears that the Reserve Bank had. And therefore, the Reserve Bank has reacted by imposing these several measures, which include four things. We'll talk about that. But let's first briefly say that in the past, it's not unusual. It's not unusual that such changes have been, it's not unusual that such concerns in the past have been seen. And if I were to think of some past instances where not similar measures, but similar, sort of blow-ups in the consumer credit segment have happened. One could think of number one in Indian context. Global context, of course, is different. Indian context itself, it's been 2003 to 2007 was a major build-up of consumer lending in the country, as the data on the right-hand side shows. Before that, the microfinance crisis, in fact, not before, but after 2010, the microfinance crisis of Andhra Pradesh. And if I were to go even little deeper in history, I think 1998, 99 also, there were a lot of NBFCs which had significant defaults in personal lending. When central banks see a substantial increase in personal lending, consumer spending, consumer lending, and the consumer lending obviously goes for consumer spending, there's several concerns it has. Is number one, it has an inflationary potential because more money with consumers means more spending. More spending means more inflation. During the COVID time, it was perfectly okay to go by Dr. Abhijit Banerjee's theory that more money with the hands of consumers means more growth, more development. But currently, as the entire world is passing through sharp increase of interest rates, probably it's not the best time to have a lot of money with consumers. I do believe that most of you are from the fintech or NBFC sector, and you would probably appreciate that most of the fintech loans essentially are lapped up by people. I mean, other than I completely understand that there are a lot of MSME funding also going on, but coming to consumer lending, most of it is lapped up by people fairly young, below 25 kind of age group, and these people essentially in consumption. The basic idea of a loan is to remove a cash flow mismatch. For example, I need to buy a house now, so I fill that gap by taking a loan now, which I would repay over the next 20 years. But when it comes to consumer spending, it does not help. And now, this is not going to increase my earnings in future, and therefore my earnings in future would still not be sufficient, and hence it would create a gap instead of filling the gap. It may also result into increasing defaults over time, and given the interdependence of the banks and the NBFCs, and that's another concern that banks exposed to NBFCs has seen a sharp increase in the past, and that also may result into some defaults in the NBFC sector escalating to a larger default among the banks, or let's say a greater financial crisis, systemic issue. And looking at all of these factors, the RBI decided to put the brakes on consumer lending by taking these 4 measures. I don't need to spend time on the statistical slide because that's something which is now very evident, that consumer loans saw the sharpest increase over the first quarter of 2023. And even before that, September 21 versus September 22 also, the growth in consumer credit was the sharpest. This is something which is very clearly coming from the trends and progress of banking in India RBI statistics, as also the growth of balance sheets of NBFCs. Now, what are the 4 measures we're talking about? Number one, there is an increase in the risk weights applicable to banks in case of consumer credit. Certain segments of consumer credit, not the entire consumer credit, but certain sectors or certain products of consumer credit. So increase in risk weights applicable to banks. Likewise, increase in risk weights applicable for consumer credit to NBFCs as well. So the increase in risk weights for certain segments of consumer credit, that's applicable to both banks and NBFCs with slight difference. I'll probably be able to talk about the differences too. Then the third thing which is quite significant is increase of risk weight in bank lending to non-banking finance companies. This one becomes even more significant, but this is not dependent on what does the NBFC in question do. The NBFC in question might be engaged in, let's say, MSME lending. So you probably say, my company is not engaged in consumer lending, but this is a generic increase in risk weights applicable to bank lending to NBFCs. There are a couple of carve-out housing finance companies have been excluded and qualifies for priority sector treatment in the hands of the lending bank. Such lending, which in turn is for on lending to, let's say, small and medium businesses, or for agricultural sector, which lending itself qualifies for priority sector treatment in the hands of lending bank, that is carved out. But in general, the risk weights for bank lending to NBFCs tends to increase by as high as 25 percentage points. We'll talk about what does it actually mean and what's the likely implications of this. And then comes the next important measure. This is a sort of an internal self-regulatory sectoral limit that for the purpose of what you call sensitive sector exposure. There are certain exposures, sensitive sectors which are required by regulation itself. Regulation says certain sectoral exposures are sensitive, therefore you need to monitor. For example, capital market exposure is treated as sensitive. Commercial real estate exposure, you're supposed to measure and monitor that. Now, as a part of the self-regulation on sectoral limits, the risk management bodies, the risk management, whatever responsibility centers of all regulated entities have been asked to set up separate sectoral limits for consumer credit. And within those sectoral limits for consumer credit, also to have a separate limit for what is called unsecured consumer credit, because that's where the whole focus lies. This one is an internal sectoral limit, and we'll probably discuss what does it actually mean. Does it mean we'll need to curtail our spending to consumer credit, or we'll need to, let's say, move out of consumer credit? Is that what it means? We'll like to discuss that. And then we talk about the implement dates of this different 4 measures. So 4 measures, once again, number one, the risk weight For banks, for consumer credit is applicable to existing as well as new exposures. Likewise, the risk weights for consumer credit to NBFCs is applicable to existing as well as new exposures. Similarly, the risk weight for bank lending to NBFCs is applicable to existing as well as new exposures. And the sectoral limit anyway has to be implemented futuristically. This, of course, will also be applicable for existing as well as new exposures. Now, the implemented as such, the circular is applicable immediately. So when you talk about increased risk weight, it applies immediately. Increased risk weight for bank lending to NBFCs applies immediately. However, for certain things, it might need some implementation time. For example, when you talk about risk weight, no one is computing risk weights on a daily basis. So when it comes to the next quarterly report that you send to RBI for computing a capital adequacy, whatever that quarterly report is due, you'll be computing capital by revising the risk weights. So the implementation is immediate, but the effectiveness of this will be tested when you compute regulatory capital as per the next quarterly report whenever you're going to send it to the RBI. As far as the sectoral limits for unsecured credit or for consumer credit itself is concerned, but the risk management team, the NBFC might have a risk management committee. The NBFC may not have a risk management committee, in which case the board of directors will probably have to take a notice. Will probably have to do internal work. They'll probably have to internally consider what limits to set. Now, we'll probably like to discuss how to set the limits. And this is a very important question for everyone, because some of the entities may be focused on consumer credit only, and that might be the only business. If my only business is to do fintech lending, how do I put a limit to fintech lending? That's exactly what I do for existence. So how to set up a limit if that's what my core business area is? That's a question we like to discuss. But this process of setting exposure limits may take time, because you need to ponder over, discuss, compute, set up the sectoral limits, and eventually need to implement whether the actual exposure is within the limits or not. The last sort of deadline for implementing the entire circular will be end of February 2024, that is 29th of February 2024. We need to move towards implementing it immediately, but make sure that it's under implementation by 29th of February 2024. So the first point that we were to discuss is, what does the word consumer credit mean? Now, consumer credit, the meaning of consumer credit comes from the standard definition for certain terms used by the RBI, which is a part of the, this is, as of now, we're getting it from the RBI's XBRL returns harmonization of banking statistics, where the word consumer credit is defined. And this definition is commonly cited because even in the penalty circular, which also used the same term consumer credit, the definition was cross-referred from the XBRL circular. So the XBRL circular is the common base for definition of certain terms. And the word consumer credit, as defined in the XBRL circular, starts by saying lending to individuals. It starts by saying lending to individuals for consumption purposes, and includes what all? So loans for consumer durables, credit card loans, auto loans. Auto loan, you would probably say, is excluded for the purpose of risk weights. I'm coming to that. Let's first understand the meaning of consumer credit, and then we talk about exclusions from the risk weight. We'll talk about that. So first of all, the meaning of consumer credit is loans given to I'm stressing once again, loans given to individuals for consumption purposes. So there's absolutely no doubt that if the loan is given to a borrower other than an individual, for example, a partnership firm, for example, LLPs, for example, companies, that's no way a consumer loan at all. So loans given to individuals for consumption purposes, such as loans given for consumer durables, credit card receivables, auto loans, loans given for consumption purposes. See, this is how the regulator defines it. Loans given for consumption purposes. If you all are giving a loan, you probably don't go and say, hey, I'm giving the loan, do consume it. You don't go and say that consume my loan. But basically, when we say we are not controlling the end application and use of the money, we give what you call personal loan, we give a line of credit, we give what you call, let's say, a buy now, pay later kind of facility, which is basically what we are giving the loan for buying some consumer durables, goods or services, or for doing what you feel like doing. So that's basically a personal loan. So all personal loans given to any individuals, personal loan given to professionals as well, excluding loans given for business purposes, and even secured loans. Even a gold loan also is a consumer loan. After all, what is the end application of a gold loan? Now, this is the meaning of consumer credit. I'm stressing once again that not all of these are actually attracting higher risk weights, but that's the outer periphery of the meaning of consumer loans. And that meaning of consumer loans excludes number one, educational loans, number two, loans given to farmers in the Kisan credit card scheme, loans given for investment in financial assets, and loans given for creation or enhancement of immovable assets, for example, home loans. So any loan given for creation or enhancement of immovable assets, for example, a home loan, will be excluded from the meaning of consumer credit. Having seen the meaning of consumer credit, let's now see what all items of consumer credit attract high risk weights. So we saw the meaning of consumer credit, and now let's understand what exactly attracts higher risk weights. So once again, consumer credit, as per definition, means unsecured personal loans, loans given to individuals for no specific purpose, any revolving or free for utilization line of credit, or line of credit given to individuals, not specifically for business purposes. But these four items, as of now, are excluded for the purpose of the higher risk weight. Number one, housing loans are excluded. What's the meaning of housing loan? That's a very complicated topic. Will require some elaborate discussions, but housing loan is excluded. That would mean higher risk weight of 125% will not be applicable to housing loans. Educational loans are also excluded, which is obviously what a loan given for higher studies. Typically, the loan is given to a student, normally for a study abroad or study within the country. It's a loan given for educational purposes. That's carved out, which is, as you can see in the definition of consumer credit itself, last slide, educational loans were excluded there as well. Vehicle loans, which otherwise would have been vehicle loan, particularly if it's given for a passenger vehicle, would have been consumer credit, but for the purpose of higher risk weights, vehicle loans are carved out. That would mean higher risk weight is not applicable to vehicle loans. Loans secured by gold or gold jewelry. This is also carved out. And in fact, the risk weights in this case might even be lower than 100%, as we will just be discussing shortly. So the gold loans, remember that when it comes to loans by NBFCs, the reference is to gold jewelry. When it comes to banks, the reference is to gold or gold jewelry. It seems that the regulatory prescription is that NBFCs can't give loans against raw gold. NBFCs can give loans only against gold articles and not gold in a raw form. But banks probably, it seems that banks can. But that's not a topic for discussion as of now. As of now, the discussion is that if it's a loan, gold loan against gold or gold jewelry, it will escape the higher risk weight. Now, it's also therefore easy to understand that if the loan is given for business purposes. Now, there were many questions about MSME loans. If you're giving an MSME loan, a loan to small businesses, MSME loan, a loan to the shopkeeper. Sometimes people even ask, you were talking about loans to an individual. If I given a loan to a proprietary firm, what happens then? If I given a loan to a proprietary firm, is there a difference between giving a loan to a proprietary firm versus giving a loan to an individual? Technically, a proprietary firm and individual mean the same. There's no different entity. The individual and the business owned by the individual, there are not two different entities there. The entity is still the same. Therefore, does it matter whether I'm giving a loan to individual or I'm giving a loan to a proprietary firm? The moment you say I'm giving a loan to proprietary firm, it tends to region that the loan is given for commercial purposes, business purposes. Because it's a business loan, it's a loan given to a concern. Sometimes we call it GST-based loan, loan based on GST turnover, loan based on a shopkeeper's shop and establishment license, whichever way we're linking the loan to some kind of business activity. The loan is a business loan, so it's not a case of consumer credit. So I think the meaning should be quite clear. Any loan given for commercial purposes will stand carved out because such loan is not a consumer, it's not a It's not a loan which is intended to be consumed away. The loan is given as a working capital loan, etc. Therefore, this loan will stand carved out. We'll take several examples to understand more on how to understand which loans will be carved out. Remember, what we're talking about currently is applicable to both banks and NBFCs. This increase of risk weights is applicable to banks and NBFCs. Slight shade of difference between the two, but largely the circular is applicable to both banks as well as NBFCs. When it comes to MFI loans, now one was able to see that in case of NBFCs, loans given to MFIs or self-help groups have been specifically excluded. In case of banks, that exclusion was not seen. Now, whether this was actually with an intent or without intent is difficult to say. But there was in case of NBFCs, the circular clearly excludes from the higher risk weight, higher capital charge, 125% risk weight. MFI loans were excluded, not so in case of banks. But does that mean in case of banks, MFI loans will attract higher risk weight? Now, it's possible to argue that MFI loan, a loan given to a microfinance. I'm not saying loan to an MFI, I'm saying microfinance loans. Loans given to microfinance borrowers, though they might end up getting into consumption mode, but essentially, at least on the face of it, they are given for carrying some business, carrying some income earning for some occupation, some business, particularly for self-help group, mostly occupations, carpenters, barbers, plumbers. These are the farmers. These are people who get loans. Self-help group is given, a loan is given to SHG or JLG group for some income earning activity, not for helping them to consume the money out. And therefore, this may also be carved out. Now, before we come to what could be the implications of higher risk weight, let's take some examples. Because a lot of people have been asking questions on what loans will suffer this higher risk weight and what loans will not suffer higher risk weight. And then we discuss what would be the implications of higher risk weight if at all the higher risk weight is applicable. So let's first understand loan given to a proprietary concern I just discussed. While the loan is given to a proprietary concern, which is the same as loan given to individual, but given the fact that you are linking it with a concern means a business, a commercial operation. Therefore, this loan, being a commercial loan, not for consumption purposes, will escape the higher risk weight. In other words, the normal risk weight of 100%, or in case of banks, even a lower risk weight might be applicable. It's an SME loan. I'll talk about what could be the risk weights in case of banks, because it might qualify as what you call regulatory retail portfolio. Even a lower risk weight might be applicable, but this will not be subjected to a higher risk weight. A lot of people were asking, what about priority sector loans? PSL loans given by banks directly. Most of the loans are not consumption loans. A loan given to farmer in any way specifically carved out. Loan given to SMEs are anyway, like we said, it's a commercial loan. Loan given for education purposes is also separately carved out. So priority sector loans are anyway not for consumption purposes. It would sound quite counterintuitive to say that a consumption loan is still a priority sector loan, because priority is something which is priority from financial inclusion, from the country's economic development point of view. It's not a development. Consumption loan cannot be developmental. So one would not say at the same time the government wants to encourage priority sector lending, it would also discourage priority sector lending by higher risk weight. So it should normally be understood that PSL loans given by banks directly will not be subjected to higher risk weights. When we talk about bank lending to NBFCs, we'll have to come back to this question once again, because there is a carve out there as well. Banks loan to NBFCs for all lending which will qualify for PSL, such that the banks lending to NBFCs qualifies as PSL lending. But then there are rate limits also. So we'll talk about that as we go. Let's first understand MSME loans. Now, once again, since the loan is MSME loan, explicitly the loan is for commercial purposes. A lot of people were asking about LAP loans. When we give a LAP loan, loans against properties, the loan is backed by property, but what's the purpose of the loan? So question is, if LAP loan is linked with some commercial activity, You are giving a LAP loan saying this is intended for working capital of a business. You are giving a LAP loan saying, well, this loan is for extension of the house. The loan is for, let's say, building a new floor. In other words, if the loan is not free, the application of the money, the end use of the money is not controlled. End use of the money is controlled. And that end use is not consumption loan, it's not consumption purposes. I could argue that the LAP loan will also not be taken as consumption loan. However, and let's repeat that, however, if while granting the LAP loan, we have not specified the end use. See, end use restriction in typical lending parlance, the end use is mentioned in the application form or maybe the sanction letter. Beyond that, lenders don't go and monitor the end use. I don't think lenders will sit in judgments to ask for certificates of utilization of the money. Particularly in retail lending, no one does that. But while applying for the loan or granting the sanction or issuing the sanction letter, if the end use was mentioned, the end use is not personal loan or what do you call consumption loan. Then if the loan is secured by a property, if it's a LAP loan will normally be excluded from consumer loan. However, if the end use was not controlled at all, loan was given on security of property, the loan is not for purchase of a house, the loan is not for development or extension of a house, the loan may not be for working capital purposes, the end use is not restricted. In that case, even a LAP loan may fall under the category of consumption loan, and therefore LAP loan also may be subjected to a higher risk weight. I hope I could make myself clear. I'll say that once again very quickly. That question is not what is the underlying security interest. For the purpose of the higher risk weight, we are not getting into whether it's a secured loan or unsecured loan. Secured versus unsecured is not relevant here. Secured versus unsecured would be relevant for the sectoral caps. I know some questions have started popping on the chat, but if you can maybe, we'll probably allow you to speak your questions once we are done with some examples. So please do come back with the question once we have a discussion around this particular topic. I know this topic is quite important and relevant for a lot of you. So I'll repeat that once again. Secured versus unsecured lending distinction is relevant for the sectoral caps, because sectoral caps we're saying within the consumer lending segment, a separate sectoral cap for unsecured consumer credit. That's where secured versus unsecured distinction becomes relevant. When it comes to consumer loan, whether the loan is secured, unsecured doesn't matter. So even if it's secured by property, that doesn't mean the loan is not for consumption purposes. But the LAP loan will not be a consumption loan if the end use was restricted or end use is specified or restricted either in the application form or sanction letter. So that is an important distinction. LAP loan given for business purposes like SME loans, no question, no doubt about it, it will not be taken as consumption loan. Likewise, loans against shares. Loan given for acquiring shares, clearly carved out. A loan given for acquiring financial assets is very clearly carved out. A loan by pledging shares, but end use is not controlled. Once again, loan against shares, but for personal use, it would still fall within the category of consumer loans and therefore will attract higher risk weight of 125%. Loan for purchase of a commercial asset, commercial vehicle, very clearly it's not a consumption loan. A loan for a personal use vehicle, while it's consumer loan, but it's clearly carved out. It's specifically excluded. Vehicle loans are specifically excluded. Remember, once again, 4 items are specifically excluded: housing loan, vehicle loans, educational loans, and loans backed by gold or gold jewelry. These are excluded. Now, top-up loan in case of housing, top-up loan in case of home. This is a very contentious topic. I know many people are top-up lending is the in thing. This is top-up lending anyway is very specifically dealt with by the circulars. We'll probably have to spend some time discussing top-up loans as well. Top-up loan in case of a housing, in US parlance, this was always called home equity lending. Home equity lending basically means what? There is a running home loan. The loan is partly amortized, which means the loan to value ratio is now quite low. As the loan to value ratio is low, you would like to retain the customer, because if you don't do that, the customer would run away. The customer would go to a next competing lender, will refinance the loan, get more higher loan amount, and therefore you will be left without the borrower. So as a customer retention strategy, most lenders have the practice of giving. It's a very good practice. There's nothing wrong. I mean, from regulatory perspective as well, there's nothing wrong in top-up lending as a practice. To my mind, top-up lending is extremely good practice because number one, you are retaining existing customer. Number two, dealing with the customer who is known to you. Instead of going and taking exposure on unknown customer, you're dealing with a customer whose track record is very clearly available with you. Customer retention, customers feel rewarded. So top-up loan as a practice is quite good. But the question basically is the top-up loan a consumer loan or home loan? You already have a house. You already bought a house. When the house was bought, let's say the value of the house was 20 lakhs. Loan given was 15 lakhs. 3 years later, the value of the house is still, let's say, 20 lakhs. The loan size has come down to 10 lakhs. So loan to value ratio is now 50%. At this stage, lender gives another loan of say 3 lakhs. He gives, abhaiya 3 lakh or le lo. That additional loan of 3 lakhs, is it for purchase of a house? The house is already there. An additional loan of 3 lakhs is being offered by the home lender. What's the end use of this 3 lakhs? Since the end use is neither for purchase of a house, and I'm assuming it's not for repair, renovation, development, refurbishing, or whatever of the house, end use is not restricted. In that case, the end use is left free, then even this top-up loan will qualify as a consumer loan. Therefore, the top-up loan will be subjected to higher risk weight of 125%. The moment I say this, you'll probably say, "Arey sir, वो तो वहाँ पे खाली depreciable movable property का लिखा हुआ है." Please understand that is the sectoral exposure. Higher risk weight and internal sectoral limit for unsecured consumer lending, because unsecured consumer lending, the perspective is whether it's secured loan or unsecured loan. When it comes to higher risk weight, I'm reiterating that there is no distinction between secured versus unsecured. So even though the top-up loan, one can argue that the top-up loan is actually secured because the existing security interest goes and covers this top-up loan as well. Nevertheless, since the end use of the top-up loan is not restricted, it will attract higher risk weight. What if the end use was restricted? Probably if you were to say, well, this loan of 25%, this additional loan of 3 lakhs is being taken for repairing the house, painting, repairing the house. I could probably argue because the end use is restricted, well, this is not a consumption loan. If you were to say 3 lakh loan is being given for buying furniture, I would still say buying furniture is no way different from a consumption spending. आप उससे 3 लाख से घर का फ्रिज लेके आएंगे, आप उसका घर का बेडिंग बनाएंगे या घर में कुछ और सामान लेके आएंगे, that is still consumption loan. So to my mind, that would still be covered by consumer lending. Loan for insurance premium in case, this is very common practice. Most of the home lenders also give loan for insurance, for insuring the house, for paying insurance premiums. Now, for risk weight purposes, the existing regulatory prescription in case of housing finance companies say a loan given for insuring the house is treated as home loan only. So this loan is actually ancillary to the home loan. Therefore, one can argue that this is nothing but a part of the home loan. Invoice finance transactions, it's very surely it's a commercial transaction. Even if the invoice happens to be for a consumer asset, I mean, how does it matter? Whose invoice were you talking about? The invoice is mostly from, it's a B2B transaction. It's a B2B transaction where no one does invoice finance for B2C transaction, because that would very clearly be a case of consumer lending. But it's a B2B transaction. The business, dealer, retailer, etc. is bought. No matter what is asset bought, but transaction is between a wholesaler, retailer, or OEM and a dealer, and therefore invoice finance transactions or so-called factoring transactions are also very clearly carved out. Gold loans are specifically excluded. Microfinance loans, like I discussed. Fintech loans, BNPL loans, to my mind, unless you have a different perspective, BNPL loans are very clearly consumer loans. Likewise, fintech loans, because these are loans given basically, I mean, so-called, let's say, straight limit, 5,000 rupees, 10,000 rupees is the limit that I get. I get the money into my wallet. I can do what I like with the wallet. If you're giving a loan for recharging your phone, you're giving a loan for, let's say, paying your air ticket in EMIs, you're taking a loan, let's say for buying a holiday. Each of these are consumer loans, and each of these loans will attract higher risk weight of 125%. In a sense, are we therefore saying that you will do a loan by loan selection of an entire portfolio? एक बैठेंगे एक loan छांटेंगे आप what will qualify as consumer loan or not? So I think mostly it would be possible to do a segment based classification. If it's possible to take some loans out of a particular segment and say these loans are spared the higher risk weight, then it's different. But otherwise, most of the so-called retail consumer loans, it should be possible to identify them by simply identifying the segment. These loans will now attract higher risk weight, both in the hands of banks as also in the hands of NBFCs. Having said this, and before I take up, and I know there are questions coming on this, but let's first quickly understand, and this is very important discussion. Higher risk weight, what does it actually mean? But what does higher risk weight actually mean? Number one, the immediate implication of higher risk weight is that your capital adequacy stands reduced. To give a clear example, absolutely clear example, assuming that your company is into consumer lending only. Let's say all the loans that you give are fintech loans, which you're very clear business focus. We are simply giving, as many of you are actually into fintech lending. Let's say we're into fintech lending. See, in case of credit cards, I should have mentioned, while in case of consumer loans, the risk weights go from 100 to 125. In case of credit cards, they go up from 125 to 150. It was 125, I think, some years back. It's now increased to 150%. So what's the implication of increase in risk weight? Very clear. Number one, let's say if my company is engaged entirely into consumer credit, and let's say I was operating with a 20% capital adequacy, which is, I think, quite good. 20% capital adequacy is quite good for most of the entities. Now, the moment the risk weights increase from 100 to 125, my capital adequacy also drops by 25%. In other words, my capital adequacy now stands reduced to 16%. As the risk weights for the assets have increased, my capital adequacy suffers a drop from 20, it becomes 16 automatically. This is without any growth in business. That is, whatever be the tickets, whatever be the balance sheet size, because you're applying a risk weight of 125%, that would mean a value of 100 crores will be read as 125 crores, on which you'll compute your 15% capital, whatever percent capital, and therefore your capital adequacy suffers a drop of 25% straight up. Now, a sharp 25% drop in capital adequacy may have implications for a lot of lenders. The same thing is applicable to banks also. If a bank is exposed, let's say, entirely to consumer lending, its capital adequacy suffers. So capital adequacy, given the extent of exposure on consumer lending, suffers a sharp drop. If you're entirely into consumer lending, you get a 25% drop in the capital adequacy. What is the implication of drop in capital adequacy? Number one, your future growth plans get affected because you are very close to the 15% capital adequacy limit. You can't anyway be going above 15. You can't be growing a business beyond the 15% capital adequacy limit. If 20% is now stand reduced to 16%, even a marginal increase in the balance sheet size will see you fighting for capital. Now, that's not good for any lender to be starved of asset growth and say that my house is already full, I cannot grow my balance sheet any further. That's not at all healthy. So that's one implication, that your balance sheet gets clogged, because with the existing amount of capital, you will not be able to grow your balance. If you're not able to grow a balance sheet, meaning you're out of market, because you can't lend. If you can't lend, you're out of the market. Borrowers don't come. Say also very important, please understand, very important, borrowers, you don't do fresh lending, your recoveries will also be impacted. This is very important. I mean, it might sound harsh, but it's meant to be harsh, that if you can't lend further, for whatever loans you've given, your recoveries will be impacted, because a lot of loans come back because the borrower intends to take a further loan from you. So that's a very serious implication of capital adequacy getting dried up. This is the implication on capital adequacy. Now, there is, for middle layer entities, there's something called ICAP. ICAP is internal capital adequacy assessment procedures. Will increase of risk weights also mean the ICAP also needs to be reviewed? To my mind, very clearly, yes. ICAP is though not based on regulatory risk weights. ICAP has nothing to do with regulatory risk weights. ICAP is a separate independent computation altogether. But ICAP is also ultimately based on expected unexpected losses. If the perception about risk of unsecured lending because of whatever headwinds we're able to see, माने RBI ने overnight risk weight 100 से 125 कर दिया, does it mean overnight unsecured lending has become riskier? Actually, that's in regulatory parlance, that's what it is. But RBI's perception is not, I mean, RBI woke up one day and say, oh, kal se 125% kar dete. But it's based on the emerging situation. See the global headwinds, see the global situation, see the increase of interest rates, see the fragility of the geopolitical environment, see the economic backdrop of the entire world. So the way the way the economies of the world are behaving, no matter our country is still a bright spot, but that's a different issue. I mean, we cannot be secluded from the global economic movements, and therefore it's based on a higher risk perception of unsecured lending, right? So in terms of ICAP also, while ICAP is completely internal, but risk management committees might have to take a note that we might need to review our expected unexpected loss computations. Next comes ECL computation. Will ECL computation also be affected? I would certainly say yes, because ECL is not merely based on historical probabilities. ECL is to an extent forward looking. It's in fact largely ECL is entirely forward looking. It's benefited from past experience, but it's forward looking. So because you're doing a forward looking computation, probability of default, if situation suggests that unsecured loans are riskier, the fact that they were not as risky in the past does not mean they will not be risky in future. Therefore, you need to review your ECL. Higher ECL means higher provisioning, and please understand that the balance sheet, the P&L of NBFCs may not be strong enough to take higher provisions. So you probably have to go and do a hard sell to your auditors as to why your ECL methodology also should. To my mind, it should. Appropriately, if I was to work on ECL methodology, I would say definitely the ECL methodology should be at least reviewed to see as to why the forthcoming scenario does not indicate a higher probability of default for unsecured loans. So these are the implications of higher risk weights. Now I can see there are questions on the chat, and maybe some of you might like to vocalize questions as well. So we've seen one part, in fact, two parts. Number one, high risk weight for unsecured lending in the hands of banks. Number two, higher risk weights for unsecured loans in the hands of, sorry, not unsecured, consumer loans. Sorry, I'm begging pardon. It's not secured versus unsecured, it's consumer loan. Consumer loans in the hands of banks and consumer loans in the hands of NBFCs. The slight difference between banks and NBFCs is that the microfinance carve-out was specifically mentioned in NBFCs. It was not mentioned in case of banks. But to my mind, it should still be possible to argue that a bank's direct exposure to microfinance loan would still be excluded. That was one difference. Second difference is that in case of NBFCs, it talks about lending against gold jewelry. In case of banks, it talks about lending against gold or gold jewelry. Now, before we take up questions, just quickly to say that if the bank has acquired exposure by way of direct assignment, will the higher risk weight be applicable if the DA transaction happens to be DA of consumer loans? Answer is very clearly yes. If the bank has entered into a co-lending arrangement and therefore a part of the loan now sits on the balance sheet of the bank and the loan is still a consumer loan, well, it would still attract a higher risk weight. Now, what if there is a default loss guarantee? But that doesn't matter from point of view of regulatory risk weight. At the most, if the default loss guarantee is fully funded, you can, if you're a bank, you could probably take a what you call credit risk mitigation. To the extent you're holding cash deposit, cash has zero risk weight. You probably say, well, my exposure is reduced by the extent of 5% because I've got a 5% cash deposit with me. So 95% of the exposure will still have to be risk weighted at 125%. The 5% cash which you're holding, you can probably claim a benefit of that. If you're a bank, this is only in case of banks. If you are the NBFC who gave that 5% deposit, the entire exposure will be risk weighted as the exposure of the guarantee giver. That's a very significant point. So if you are the one giving the guarantee, the capital requirement will not be 15% of the guarantee amount. It would be 15% of the entire portfolio amount, because you are carrying the risk of the entire portfolio. And if that portfolio is consisting of consumer loans, the risk weight for the consumer loans will be read as 125%. I think I can maybe repeat that point once again, because many of you are probably giving first loss default guarantees to portfolios. Repeating once again, if you are the guarantee provider, either as a loan sourcing agent, or some people actually in case of co-lending also give FLDGs. So assuming you're given a 5% FLDG against a portfolio of rupees 100 crores, right? You're given a 5% FLDG, 5 crore FLDG for a portfolio of rupees 100 crores. And the portfolio consists of consumer loans, as we just discussed. The question is, what's the implication? What is the capital requirement for the guarantee provider? That is the NBFC. The guarantee provider will first be required to maintain capital at the rate of 15% on the entire portfolio, 100 crores. And that 100 crores will be risk weighted at 125%. Therefore, the value of 100 crores is taken as 125 crores, on which you compute 15%. So how much is 15% of 125, whatever that amounts to? Let's say roughly about 18 crores. But can you suffer 18 crores? Answer is no, because you have given a guarantee of 5 crores only. So at the most, your loss is limited to 5 crores. Therefore, 5 crores will be the capital required. It's not 15% of 5 crores, but 5 crores itself is the capital required. So that's the treatment in case of FLDGs. So in case of direct assignments and co-lending transactions, your exposure will be risk weighted based on the nature of the loan. In case of securitization or pass-through certificates, I'll discuss separately. We'll come to that separately as a topic. So as of now, I think there are several questions on the risk weight itself. Let me open the chat. And if any of you would like to speak your question out, you can certainly say that. Okay. The question that I can see on the chat, there's a question by Mr. Balasundar. Capital adequacy goes below the threshold limit on account of increases weight. What's the recourse available to lenders? That's a very important question. If we find suddenly when we fill up a quarterly return that my capital is fallen short, it should actually be very serious, because capital adequacy is something which is very seriously monitored by the risk management committee. Risk management committee is the one which is tasked with ensuring adequacy of capital, as also internal capital adequacy assessment procedures. Please understand that when it comes to middle layer entities, regulatory capital is one, then there's ICAP as well. And in parallel, you need to make sure that not only based on the value of assets now, but based on the potential increase in asset value, the capital is sufficient. So if suddenly we find that the capital is becoming inadequate, it's a serious concern for the risk management committee, because normally every NBFC keeps a safe cushion. When RBI has raised risk weight from 100 to 125, the cushion should have been there with NBFC. No one plays on the boundary line of 120 of 15% capital. People keep sufficient cushion, so that's a very serious concern. But I would say the immediate implication is that the NBFC should plan immediately increase of capital, which means what? Maybe raise tier 2 capital. That's part one. And in the meantime, stop for the business or do business sell down. Think of a direct assignment out. Think of a direct assignment out. Maybe think of a securitization out. So think of reducing the portfolio values unless you are able to manage a tier 2 capital infusion on an immediate basis. This was Mr. Bala's question. The question was, there was a question, is it applicable to base layer? Of course, it's applicable to all NBFCs. The circular is applicable to base layer as well as middle layer entities. There was a question on YouTube, unsecured business loan given to a company by an NBFC will be classified. No, not really. If it's unsecured business loan, if this question is coming from our YouTube viewers saying is unsecured business loan will attract 125% risk weight, the answer is no. The moment you say it's business loan, it's not a consumer loan, hence no question of the higher risk weight being applicable. Will JLG come under JLG. Once again, joint liability groups or self-help groups are groups of microfinance borrowers. Like I mentioned, I assume, and I hope that my assumption is correct, is that microfinance lending is not given for consumption. It's given for income generation, occupation purposes, and therefore, in case of JLG loans or SHG loans, in my understanding, the higher risk weight will not be applicable. Uh, then there's a question by Srimoy. In case of co-lending, the risk weight should be not really, Srimoy. I think I tried to make myself clear, but maybe I can repeat once again. As I said, if you are the one providing the guarantee, first loss guarantee support, the FLDG is the limit to how much loss can you suffer. That's the outer limit. You can't suffer more than 5% because you guaranteed only 5%. But the guarantee of 5% pertains to what? 100%. The entire pool, in the entire pool, any loan that goes bad, the loss will be attributed to you. So the 5% is the limit of your losses, but the source of the loss is the entire portfolio. So if you are the one giving a guarantee, if it's a first loss default guarantee, if it's FLDG, if it's second loss or senior guarantee, I would have probably changed my answer. But because it's first loss guarantee, therefore, as a first loss guarantor, the portfolio value will now be multiplied by 125%. And on that, the capital requirement of 15% will be applied. Then I compute what is the amount of guarantee. It's only 5%, 5 crores. So lower of the two, that is 15% of 125% of the portfolio. Sorry, I'm repeating once again. 15% times 125% times the portfolio value, or rupees 5 crores, which is the size of the guarantee, the lower of the two. Very surely 5% is the lower of the two. Therefore, the capital required will be 5%, 5 crores. I'm reiterating the capital required is not 15% of 5 crores. The capital required is 5 crores itself. But that's what you are likely to lose. Therefore, 5% is the capital required. This was Sriman's question. I hope I've been able to clarify, but should you still have question, I think if Srimai wants to speak, colleagues can unmute her too. I've got a question from Dikshant. Processing fee deducted on home loans, which NSB says is non-housing loans, will be recovered. If the loan is given for buying a house, now I'm just trying to understand the facts because this question was raised by somebody else also, and I was probably not able to understand. Let's say I give a home loan of 10 lakhs and the processing fees, let's say 50,000 rupees. So first disburse 50,000 rupees with which the loan is sanctioned. Thereafter, do I disburse 10 lakhs or do I disburse 9.5 lakhs? If I disburse 9.5 lakhs, then the loan sanction was 10 lakhs for buying a house, of which part of the money was used for processing, but once the processing succeeded, it was deducted from the home loan. That would mean the entire amount of 10 lakhs, I mean, what NHB treats for treating as a value of housing loan, that's not relevant. There's a definition of housing finance in the Basel circular, which I'll be coming back to shortly. There is no doubt that the entire amount of 10 lakhs was the home loan. However, if you say 10 lakh was the home loan, I give another 50,000 for processing fee. Therefore, I give a loan of 10.5 lakhs. Then the 50,000 rupees is not a home loan, unfortunately. Another question from maybe YouTube. In case of base layer, there's no CRAR, hence the risk weight increase will not be applicable. I think that's a fair point to make, that in case of the CRAR itself is not applicable to base layer entities because they are required to observe a leverage limit. So I think that point, to the extent of risk weight, probably yes, but rest of the circular is still applicable. Mr. Balasundar, I understand that the increased risk weight is applicable to unsecured credit, whereas in case of LAP loan against shares, there's security available. The loan is unknown. The end user of the loan is unknown. No, Mr. Balasundar, once again, I would reiterate the point I'd made earlier. When it comes to higher risk weight, the question is not whether the loan is secured or unsecured. Secured versus unsecured distinction is relevant for the internal limits on sectoral exposure. When it comes to consumer loan, the point is this loan given for consumer consumption purposes or not? If the end use was specified by the borrower or was mentioned by you in your sanction letter, then you probably say at least the loan was not given Whether the loan being given, say for business purposes, was diverted into funding a marriage, that's a different issue. That's misapplication of the loan. You are not, I mean, sort of sitting, controlling the application of the loan as such. But the loan was avowedly given for no end use at all. In that case, the loan may be taken to be consumption loan. And there, even though the loan is secured, it may still be, taken to be high risk weight. So here the question is not whether it's secured or unsecured. Moving forward, now we talked about co-lending transfer. As far as securitization is concerned, now that's very interesting implication of this revised syndrome. What happens in case of securitization? The underlying loans may be consisting of consumer loans from which pass-through certificates are created. The bank buys pass-through certificates. What will be the risk weight in case of pass-through certificates? Will you look at the risk weight for the underlying loans, or will you look at the rating of the securities? Now remember, in case of securitization, the risk weights have nothing to do with the composition of the portfolio. In case of securitization, the risk weights are based on rating of the pass-through certificate. Assuming the bank is buying a AAA rated pass-through certificate, even though out of a pool consisting of consumer loans, the risk weight may be as low as 15%. I'm nowhere talking about 125% here. A bank buys a AAA PTC arising out of a portfolio of all consumer loans if it's adequately credit enhanced so as to reach a AAA rating. The risk weight, of course, the risk weight is computed as per SSA direction. There's a complicated computation from a long table which talks about several things. Number one, is it senior exposure, non-senior exposure? What's the rating? What do you call the tenure of the transaction? And then one needs to do an interpolation, but the risk weight is somewhere between 15 to let's say 30%, depending on various factors. But the risk weight may be as low as 15% if the bank is buying a AAA PTC, though coming out of a consumer loan portfolio. So that creates a very new, interesting, motivation for securitization. The bank buying a consumer loan portfolio itself or buying the portfolio under a DA transaction will be charged with 125%, 125% risk weight. If the very bank buys a PTC coming out of the same portfolio, if it's adequately credit enhanced to become AAA, the risk weight may drop down to as low as 15%. That's a huge, I would say, motivator for securitization transactions going forward. As you can understand, the market is now moving decisively towards securitizations as opposed to direct assignment transactions or co-lending, direct assignment transactions, I would say. So this might be a new region to look at securitizations as opposed to direct assignment. Let's come to the third part, change of risk weights in case of lending by banks to NBFC. This is something which is most important, because this is very strongly highlighted by the press as well. High risk weight for bank lending to NBFC. So here there are two carve-outs. HFCs have been carved out. Housing finance companies, as defined by the master circular of the RBI, depending on the individual home loan versus home loan focus concentration. If the company qualifies to be a housing finance company, in that case, the higher risk weight for bank lending to NBFCs is not applicable. Number two, the second carve out is such lending by banks to NBFCs, which qualifies as a priority sector exposure. Bank lending to NBFCs may qualify as a PSL loan if the lending by the bank is for all lending to specific customers. For example, loan lending to agri, on lending to small and medium entities, micro and small entities, MSCs, not MSMEs. And there are, of course, limits on ticket size also. I think in case of MSCs, it's 20 lakhs. In case of agri, it's probably 10 lakhs. So if the bank has given a loan specifically for on lending to agri or to MSEs, then if the bank lending to the NBFC is treated as priority sector, then also this higher risk weight for bank lending to NBFCs will not be applicable. Otherwise, irrespective of what business the NBFC is engaged in, the risk weights for the banks to NBFCs will stand increase by 25%. So the question is, how is the risk weight computed? The risk weight for banks to NBFCs is computed based on the Basel table. The Basel is given a table of risk weights. For example, 20% is the risk weight for AAA, 30% is the risk weight for AA, 50% is the risk weight for single A, and 100% is the risk for triple B. As the rating, let's say, goes to double B or single B, the risk weights continue to go up. It might even go to something like 250%. If it's C, it might be deduction from capital straight away. So the risk weights are as per the Basel table. But whatever is the risk weight in the table will stand increase by 25%. So in a sense, if the bank is giving a loan to a AAA NBFC, the risk weight originally was 20%. That risk weight now becomes 45%. 20 becomes 45 because 20% risk weights will get incremented by 25%. Remember, therefore, the bank giving a loan to NBFC, AAA NBFC, assigns a 45% capital, 45% of the exposure. I mean, the capital is not 45%, capital is 9% on 45%, 9 or 11.5, whatever you take it, because in case of banks, the capital requirement is 9. There's a 2% capital conservation on top of that. So that becomes 11.5. So whatever is the capital requirement for banks will be risk weighted. The exposure is risk weighted at 45%. Whereas the same bank giving a loan to a AAA non-financial entity, the risk weight is 20. Remember, rating being the same, the capital requirement is more than double in case of NBFC. I'm making this point once again. For the bank giving a loan to a AAA corporate versus the AAA NBFC, the capital required, though with the same rating and therefore apparently the same risk, the capital required is more than double. So suddenly the banks will start, the bank's balance sheet will start eating substantially higher capital for lending to NBFCs. Can the banks afford it? Depending on what's the capital adequacy of the bank, but lots of banks are or maybe in future starving for capital, particularly when expected credit losses are implemented by the RBI. So if that happens, banks will also be fighting for capital. Therefore, a bank can ill afford to have or to be sort of prodigal with its capital. The bank cannot afford to waste its capital by providing more than double capital in case of a AAA NBFC. That would actually mean what? You would have probably read all through the financial press that the cost of lending by banks to NBFCs may increase. Why would it increase? Because suddenly bank lending to NBFCs will start eating substantially higher capital. Capital is not, as such, it's not straight away priced. Increased capital requirement doesn't mean higher risk of lending. But of course, capital is important for a bank. And therefore, if some lending eats up higher capital, the bank would obviously start expecting higher rate of return, which is why the cost of lending by banks to NBFCs will increase, which is why the financial press was saying that NBFCs may be left to run for bond issuances, and therefore the bond markets also might start pricing NBFCs at a higher rate. So that's barring those two carve-outs, bank lending to NBFCs in general, irrespective of whether the NBFC is fintech lending entity, whatever lending, maybe it's gold lending entity. The NBFC is a gold loan company. Gold loan itself has been spared from the higher risk weight, but banks lending to NBFC, even if the NBFC in question happens to be gold loan company, there's no carve out, and therefore the higher risk weight will be applicable. So basically, what does that mean? The substantial increase in banks' exposure to NBFCs will now see a truncation. We were earlier saying the risk weights in case of housing loans are not 125. So what's the risk weight in case of housing loans? Risk weights in case of housing loans depend on, are you covered by the Basel III circular? Are you not covered by the Basel III circular? Banks are covered by Basel III circular. HFCs or NBFCs are not covered by Basel III. There is a separate direction in case of HFCs and NBFCs. So the risk weight for banks in case of what is claim against residential property. Home loans under the Basel, the term is claims against residential property. That's the word used in Basel 3, para 5.10 of Basel 3 circular. I'm referring to RBI circular. RBI circular implementing Basel III norms, but the circular is that of RBI. Therefore, the language is that of RBI. And here the meaning of housing finance, see the meaning. Lending to individuals. Number one, lending to individuals. So lending to a builder will not come here. Lending to individual meant for acquiring residential property, fully secured by mortgage on the residential property that is or will be occupied or that is rented. The loan is for acquiring. Acquisition need not mean purchase. Acquisition might be building also, construction also. Loan to an individual fully secured by mortgage for acquiring or constructing residential property, which will be either used for self-occupation or for renting. This will be risk weighted with a higher, with a lower risk weight. What's the risk weight? 35%. If the LTV is, I think 70, whatever, I think 75% or less, probably 75% or less, then the risk weight is 35, or else it goes to, I think there are 3 risk weight bands. But the risk weight in case of housing finance is much lower in case of banks. So that risk weight remains intact. There is no change in risk weight for home loans, neither for banks nor for HFCs. HFCs or NBFCs, once again, based on LTVs, the risk weight may be 50 or 75 or 100, depending on the size of the loan, depending on the LTV. But those risk weights are not impacted. But remember the meaning of housing finance, therefore, as coming from the Basel circular, is lending to individuals for acquiring residential property fully secured by the mortgage. Here, the definition of housing finance for HFC classification is not relevant. What is relevant is the RBI's Basel circular, because that's where the capital, that's where the risk weights are coming from. So that definition will be relevant. We talked about lending to NBFC. Now, quickly to understand, bank giving a loan to NBFC, the risk weight is 25% higher than the risk weight applicable based on the rating. Purchase of portfolio. What is the relevance of this comparison? I'm trying to see in future, will banks be willing to lend on the balance sheet of NBFCs, or will banks be willing to acquire portfolios either by DA transactions or by co-lending or by securitization? That is like what happened post the ILFS crisis, where suddenly banks were averse to lending to NBFC. They started buying the portfolios or investing by way of securitization. Would we see a strong move towards either of these 3 methods in time to come? If the bank lends to NBFC itself, the risk weight is 25% higher than the rating-based risk weight. Assuming the NBFC has a single A rating, the risk weight is 50. Therefore, now the risk weight will be 75. If the bank buys the portfolio, it would depend on what is the risk weight for the portfolio. If the portfolio happens to be consumer loan, the risk weight is 125%. If the bank enters into a co-lending arrangement, the risk weight is still, once again, depending on the nature of the portfolio. If the risk weight is, if the bank enters into a securitization transaction, like I mentioned, depending on the rating, depending on the maturity, and depending on the seniority, the risk weights, however, may be as low as 15% for what is a non-STC. STC is simple, transparent, comparable transaction. If it's an STC transaction, the risk weight may even be lower at 10%. So the risk weights may be significantly lower in case of securitization. That, as I mentioned, is a strong region for entities to start looking at securitization. I'll come to top-up loan because top-up loan is connected with the internal exposure limits. So let me first talk about internal exposure limits. And then I think we'll open up for questions if you might have. Now, this is the last part of the RBI circular. Internal limits, self-imposed caps on sectoral exposure. The RBI expects that henceforth, the risk management teams, if the company in question does not have a risk management committee, then the board of directors will probably have to discharge it. The board of directors or the risk management committee will set internal limits. Internal, the limit is internal. Regulator does not say what the limit should be. Regulator is expecting you to set up your internal limit. On what basis do I set the internal limit? That depends on what my business diversification is. If let's say I'm into vehicle finance, I'm into commercial lending, I'm into MSME lending, I'm into fintech lending as well. So fintech lending is a segment of my overall book. There I'll probably say, well, I will not expose myself to more than 10% for fintech lending. See, lots of banks are into digital or fintech lending. Their exposure to fintech lending is how much? Barely 1%, barely 1 or 2%, probably even less than that. But if you talk about a fintech lender itself, what's the exposure of fintech lender on fintech lending? And that's what I do. That's it. That's what I do for a living. So my exposure is of course 100%. So question is, how much limit does the risk management team or the board of directors ascribe to consumer credit? Depends on what's the business focus. If the business focus is consumer credit only, does it mean in that case I will not have a sectoral limit? In that case, I have to define a sector. It's within consumer credit also, probably it might be possible to decide a sector. For example, can I probably say that loan sourced through LSPs, I'll probably set a limit. There probably I might say the risk is perhaps higher. Loans which don't have the guarantee, loans which don't have FLDG support, probably I can set a limit on that. Probably I can say loan to borrowers with a credit bureau score of less than 750. I can probably set a limit. So this self-imposed limit is purely a matter of risk mitigation, and no one can probably say that risk mitigation is not relevant to my business. So whatever might be the relevant limit for risk mitigation purposes, internally you need to set that limit, and within that limit of consumer credit, have a separate limit for unsecured consumer credit. For this purpose, for the purpose of that is internal risk control, exposure limits, or what you call internal risk pricing, top-up loans which are based on depreciable movable property will be regarded as unsecured loans. Even though technically it might be possible to argue that top-up loan has the benefit of security on the main transaction. But for the purpose of setting the internal sectoral caps and for the purpose of pricing, credit risk pricing, a top-up loan will be viewed as an unsecured exposure if the top-up loan is in connection with, or top-up loan, the primary loan was against a depreciating movable property. Take an example. Here it doesn't matter. Take the example of, let's say, vehicle loan. A top-up loan is given to a vehicle, a commercial vehicle buyer. The loan itself was commercial vehicle. Loan itself was for commercial vehicle. Top-up loan is given to the borrower under commercial vehicle. Question is, what's the purpose of the top-up loan? One could probably argue that the top-up loan was given for working capital. If the top-up loan was given for working capital, I could probably argue that it's not a consumer loan at all. But top-up loan, there was no strings attached. It's a consumer loan, can be used for consumer purposes. The top-up loan is for a depreciable movable property. And in that case, the top-up loan will be classified as unsecured exposure for the purpose of the sectoral caps. I'm repeating once again, this is not for the higher risk weights we discussed earlier. This is for the sectoral caps, because the nature of this loan, though it's secured, it probably shares the security interest on the main loan. But for the purpose of sectoral caps, it would be treated as unsecured loan. So that's the meaning of the sectoral caps, which are internal limits to be set by the NBFC. So we've just tried to explain what exactly is top-up loan. Top-up loan basically will be a top-up loan merely because it's a second loan facility to an existing borrower. It does not become a top-up loan. Top-up loan means it must be sharing security interests with the original loan. If it shares a security interest with the original loan, in that case, therefore, you probably can argue that the top-up loan is actually secured. For the purpose of the sectoral limits, this loan will be treated as an unsecured loan. I believe there are several questions coming on the top-up loans. So let me just quickly see the questions on top-up loans. Harjinder Kaur has a question: does sectoral cap need to be defined for business loans as well as the NBFC? Sectoral cap is basically for consumer credit. If the NBFC is in the business of giving business loans, will probably, as a matter of policy, but I mean, any company which is, let's say, for business loan would probably still say, I remain open to opportunities for non-business or consumer loans as well. So as a matter of policy, I don't think one would rule out that my company will not give a loan for consumer purposes at all, even though even though I'm intending to give loans to SMEs only. But from risk management perspective, if the company sets a limit is what? It's an outer limit. I'm not saying that I will start lending. I'm putting an outer limit. So to my mind, there's nothing wrong if I would be perfectly okay with the company saying that we will not give consumer loans are untouchable for me. I'm perfectly okay with that. But if the company wants to say that we can look at some degree of exposure, अरे थोड़ा चखने के लिए कुछ तो चाहिए, तो अगर ऐसा चखने के लिए कुछ चाहिए तो बोल सकते हैं भाई 5% I will extend to consumer loans. So there's nothing wrong in saying that I will not extend to consumer loans at all, but at the same time there's nothing wrong in putting some small limits for consumer lending as well. Any impact on loans in pipeline also will be equally. Loans in pipeline as also the loans already given. They're all impacted. Therefore, this is applicable. There's no grandfathering here. Therefore, it's applicable to all loans. Top-up loans on MSME loans, where the underlying collateral is property. So, like I mentioned, top-up loan on underlying property. Questions can be seen once again in two perspectives. Number one, what's the risk weight? Number two, will it be taken as unsecured exposure for the purpose of sectoral cap? If the underlying exposure is on property, meaning immovable property, it's a top-up loan which is sharing security interest with the main loan. That would mean, clearly speaking, the documentation says that until the second loan is repaid, there will be no what you call NOC given for the original loan. I'm repeating once again. Sign the second loan with the borrower. It clear. Therefore, the borrower also agrees that the security interest created for the loan number one will apply to loan number two as well. Therefore, now until loan number one and loan number two both are repaid, the security interest will not be released. We will not give NOC until both the loans are repaid. That would mean the security interest is shared. If the security interest is shared by the second loan, that's what makes it a top-up loan. And the top-up loan is now secured on immovable property. In that case, I don't need to take it as unsecured consumer credit. Number one is anyway not consumer credit because probably the top-up loan is given for business purposes. In any case, it's not unsecured, so I will not take it for the unsecured exposure. Yeah. So I think I've answered Shimoy's question, but Shimoy, in case you have any questions still, please do feel free. So I think that's what we, there is one last question. Okay. Anyone else who has any question, or else it's time to thank you all. It was quite impromptu because we announced it yesterday. Short interest. So thank you all very much. But if you have any question, kindly either put in the chat or probably ask to unmute yourself based on whatever questions. Yeah, yes, we will be putting this PPT. This PPT that we've used here, we'll be putting it on our website. You can probably download it from there. And in any case, we have uploaded the FAQs because the PPT is based on FAQs. So we have uploaded the FAQs on our website already. We also uploaded an article the very day on 16th itself, which was later on revised on the 17th. So thank you very much, everyone, and hope that this was still a good use of our afternoon, a Saturday afternoon. But thank you very much once again. Bye-bye.